It's been a little over a month since Donald Trump was reelected President of the United States. In our last gold market commentary video titled How Low Will Gold Go? In reaction to the Trump election, we detailed how the world that Donald Trump is going to inherit in 2024 is vastly different, more complicated, and potentially much more dangerous than the one he inherited in 2016. Many of the problems Donald Trump has to face today didn't even exist in 2016, and now we have a potential European economic crisis looming on the horizon. In this gold market commentary for December 6, 2024, we'll drill down on what's been happening in Europe to give us cause for concern. We'll review what's happened to gold and silver over the last couple of weeks, and we'll go over the latest U.S. economic data as well. Hi, I'm Dana Samuelson, president of American Gold Exchange in Austin, Texas. We are a national physical, precious metals, and vintage U.S. gold coin dealership operating out of Austin, Texas. If we can help you with any of your physical precious metals buying or selling needs, we'd love to have that opportunity. In this update, we'll review how the U.S. economy and employment have remained pretty resilient. We'll take a look at the big problems that are occurring in Germany, Europe's #1 economy, and France, Europe's #2 economy, that give us pause for concern today. We'll take a look at the latest gold and silver charts and show you how gold is consolidating and silver too after making big gains this year. We'll also take a look at the latest yields on the 10-year Treasury, the federal funds rate, and of course, the dollar. And I would be remiss if I didn't mention that we're having our annual inventory reduction sale due to taxes that we have to pay on the total value of our inventory at the end of the year. We always sell down our inventory as low as we can going into the end of the year, and we're passing those savings on to you. So let's get into our update and take a look at the latest U.S. economic data. This is the same chart that we showed you the last time for U.S. GDP. For 2024 off to the right. And we're showing you this because GDP was revised in the second revision for the third quarter at the same rate it was during the first go around at 2.8%. So the U.S. economy, GDP for the third quarter was unchanged when it was revised, staying at 2.8%. And it's estimated that U.S. GDP for the fourth quarter will come in at about 2.2%, weaker than it has for the last two quarters, but stronger than it was in the first quarter. So the U.S. economy continues to fare fairly well. Let's take a look at employment. We got the latest BLS employment non-farms payroll data this morning. And in November, the U.S. economy created 227,000 new jobs, which are better than expected by a little bit. We saw October and September revised upward a little bit as well. So job creation in the United States remains choppy, but good. We've added a new component to compare this year to last year, specifically 12-month rolling period. And the 12 months preceding the current 12-month period that we're in, for most of 2023, on average, the U.S. economy the U.S. employment market grew at 238,000 jobs per month on a 12-month rolling basis for most of 2023. Now, from December 23 to November 2024, the latest 12-month rolling period, we're averaging about 189,000 new jobs per month, or about 50,000 new jobs per month less than we were averaging during the previous 12-month rolling period. This takes some of the choppiness, the highs and lows that we see in this market, and makes it more relatable. So this is part of why the Fed has some concern over the employment market, because we are going into a gradual slowdown, but the U.S. economy remains pretty good. So to defend from a weaker employment situation, the Fed has started to go into a rate cut cycle And we expect the Fed, like the market does, 88% of market participants are betting that the Fed will cut rates a quarter point at the end of their meeting, December 18th, a little over a week and a half from now. So pretty much everyone thinks that there's another quarter point rate cut baked into the cake. And we think that that's what will happen as well. However, because inflation's remaining a bit stuck and the US economy is proving to be a bit more resilient than expected, market participants are also expecting that the rate of rate cuts going forward will be less. So the glide path for lower federal funds rates will be not as sharp as it was anticipated to be just a couple of months ago when the Fed stunned us with a half a point rate cut in September. So the US economy is doing fairly well. The Fed's going to continue on a rate cutting policy, but it may not be as sharp or as fast as had been previously anticipated unless things change. Which brings us to the problems that we're seeing in Europe, which could potentially domino into the US economy, which is why we are concerned about them. Specifically, Germany and France are having some major economic problems. Germany is the Eurozone's #1 economy. France is the Eurozone's #2 economy in size and GDP. And they're both having issues that are related to the same thing, the Russian invasion of the Ukraine, the subsequent energy shock that both countries have gone through because of the sanctioning of Russia and the Russian energy, oil, coal, and natural gas. They both suffered through inflation just like the rest of the world has. They're both seeing higher debt and higher interest rates today, which are causing their budgets to be challenged. And now, because of the way the Eurozone is constructed, they have to stay within parameters for the relative amount of debt they have to the amount of growth or GDP they have and the size of their economy. And that's straining them at the seams. And the potential austerity programs that they may have to go into to combat these problems, to lower expenses, like Donald Trump wants to lower expenses here in the US as well, are causing social unrest and have caused both governments in Germany and France to collapse. Germany in late October, early November, and France just in the past week. And the biggest problem is that both of them have is China's weak as well. So China is trying to export the manufacturing capacity that it has in its steel and its automobile industries outside of China, where they cannot sell their own products as well to other countries, which is undercutting the German economy for car production, steel production, and other things as well. So it's a kind of a double whammy: higher energy costs, inflation, higher debt servicing, and now their ability to sell their way out of the problem is being compounded by China undercutting them, trying to sell their way out of their problems. So this is a cumulative, longer-term problem that's coming to a head now for both countries. You can see on the German economic stagnation document that I've put up on the screen where the problems are. And specifically, Germany's automobile industry is having big problems. Both Volkswagen and BMW are in trouble. But the bigger auto industry as a whole is now suffering from the domino effect and mass layoffs. And I think Bosch is emblematic of the problem that's happening. They're cutting 55,000 jobs globally, and their products go into virtually every single one of the 1.5 billion vehicles that exist worldwide. And now they're having problems. And what the real problem is, they don't agree internally in either country how to stimulate their way out of the anemic economy that both countries face. So German Chancellor Olaf Scholz and French Prime Minister Michel Barnier have both been ousted in no confidence votes. And here you can see on the French economic crisis document that I've put up how France is facing some of the same problems that Germany is. France's debt to GDP is about 120% today, similar to the US. Germany's debt to GDP today is about 60%, so they're in better shape. France's deficit's about 6%, higher than the eurozone allows, so their austerity programs have to be more dramatic, which is what is causing the social unrest and the collapse of the government, because again, they can't agree on how they're going to cut spending and maintain the lifestyle that they have. Germany's debt has got a debt break at 3%, and they're challenging that 3% of their economy. They can't have deficits greater than 3% of their economy. So both are being pushed to the brink of making hard decisions because of the eurozone parameters for the euro currency of where do they cut, where can they grow, and there's just disagreements. The big picture problem here is that France is now in worse economic shape than Greece, Spain, and Italy. And many of you remember the Greek debt crisis from about a decade ago and how sensational that was for the eurozone. This potential problem with both Germany and France facing economic challenges is potentially much, much bigger. And we are in a global economy. And the US is the only economy that's holding up right now. China's continues to be weak. And now the number one and number two economic engines of Europe are both being challenged. Here is GDP for France, for Germany on top and France below since 2022. And you can see how GDP for both has dropped, especially in 2024. Germany's been flirting with recession for over a year now. And it's very possible that France could tip into recession as a result of what's happening there now as well. And it's hard to see how that may not domino into the US eventually. So this is a problem we're going to keep our eyes on going forward, and it's potentially a big one. And it's also helping to undercut the US a bit because of China's behavior, specifically with their growth as one of the biggest automobile industries in the world today, leading in the EV market and undercutting the traditional car manufacturers, because the Chinese car manufacturers are more nimble. They can create new designs more quickly, faster, update them more quickly, and they're trying to export that which they cannot sell domestically and at low prices. And it's undercutting GMC too, as you can see on this chart, with their sales declining and a write-off of more than $5 billion in investment that it's had with joint venture with Shanghai's SAIC Motor Corp. So there are problems afoot because of the economic slowdown in China, the war in the Ukraine, and the resulting problems that have happened with energy or have dominoed to the tipping point into Europe now. And it's going to be hard to see how the US will sidestep these issues going forward. Let's get into the traditional charts that we look at. This is the 2-year federal funds rate and the 10-year US Treasury yield. As you can see in black, the federal funds rate has come down since the Fed started their rate cut cycle. The dotted line all the way off to the right from 4.65% to 4.4% is the anticipated quarter point rate cut that we think we'll get from the Fed on December 18th. Meanwhile, you can see how the 10-year Treasury yield, which had been running from mid-September into the presidential election, went a little bit higher to almost 4.5%, but now the 10-year Treasury yield has rolled over as well. And the difference between the federal funds rate and the 10-year Treasury yield is starting to remain pretty steady. We think the yield has come down partially because of the problems that have been happening in Europe. When buyers come into the US market, they have to, with foreign currency, they have to buy the dollar first. That tends to buoy the dollar. But if they go into US treasuries, which are safe haven investment, they will push the yield down in the process. And that's exactly what's happened over the last couple of weeks. The yield on the 10-year treasury has dropped from about 4.5 down to about 4.15 today. It's a pretty big drop. That's helping to buoy gold. So we think that this will continue, although the market is starting to challenge the Fed for who's going to dominate the interest rate going forward. And that was one of the messages we got out of the just concluded New Orleans Investment Conference, that the Fed may be losing control of the interest rate via what people will tolerate when they're investing in U.S. treasuries, whether they're 3 months, 3 years, 5 years, 10 years, or 20 years. Especially the longer duration treasuries, investors are demanding higher yields for the most part to take the risk for the time involved for the return that they'll get. So we'll see how that pans out as time passes. Here's a 1-year dollar chart, and you can see how the dollar was rising going into the Trump election, and then the dollar spiked based on the promise of Trump tax cuts and deregulation, better U.S. economy, tariffs are potentially inflationary. We'll see how those transpire. The dollar ran up to about 106.5, which is where it was when we updated you last. I thought it would top out there, but then it squeaked up a bit higher to 107.5. I think a lot of that has to do with what's been happening in Europe as those investors fleeing the weakness of the eurozone have bought into the U.S. market. They've buoyed the dollar, but now we're starting to see the dollar roll over. I think we'll drop back below 106 into the 105 to 104 range going into the rest of the year. Time will tell. We had a similar Trump dollar bump in 2016 that lasted about 2 months, and then it gave away most of those gains. We detailed that in our last update. So I think the dollar will continue to come down, which will help to buoy gold a bit. And let's take a look at the gold and silver charts. Here is a 1-year gold chart, and you can see how gold has consolidated where the ellipses are, and then it made a big move higher in the spring, consolidated through the summer, and then made another big move in August to the 2801 peak at just in late October. And now we're in a third consolidation phase after gold's had one of its biggest annual gaining years since 2010. Right now, the 12-month rolling average gain is right at about 30%. So gold's had a really strong year this year, and now it's going into a consolidation phase again with support at 25.60, resistance at about 27.25. I think the pivot point is 26.50, give or take about $75 to the high and low of 26.50. So 25.75 to 27.25 is where I expect gold to trade going forward until we see a directional change either higher or lower based on what happens as time continues to pass. We do know that our debt's going to continue to go up. We'll probably see rates come down and the dollar come down, which are good for gold. We've got 2 international wars going on, and that's helping to buoy gold. And we'll just have to see how these things transpire once Donald Trump becomes president and his policies are enacted. Here's a 6-month candlestick chart of gold showing about the same trading range. On a drill down, you can see gold has bounced off of 25.60 pretty well, holding in the 26.50 range with the top hitting resistance at 27.25 after making a big move since early July. So I expect gold to move sideways for the next coming weeks, through the end of this year and into early next year until we see things, how things start to shake out once we get into the new year. So we are in a consolidation phase which is giving us what I think is a pretty good buying opportunity. I've just come back from the New Orleans Investment Conference. The market for gold remains very bullish as a consensus. We're looking at probably $3,500 price tag for gold in the very near future. Above that, we'll just have to see how things go. Gold potentially has another 20% ahead of it in a world that is unstable, potentially dangerous, and potentially economically weak. Let's get into silver. Here's a one-year silver chart. You can see silver is choppier than gold. Its direction has been a bit more challenged to the upside at resistance points. Like gold, it has about a 31% 12-month rolling gain right now, and it's going sideways into a consolidation phase, holding support above 30.50 on the daily, on the annual chart rather, with a resistance at 32.50. Above $30 is very good for silver to hold its gains right now. I don't think it'll give up much below that were to weaken a bit further. But right now I see silver moving sideways in the 30.50 to 32.50 range, again, into early next year until we see how the new presidential policies shake out and what else happens in the world. Here is the candlestick chart showing the same 6-month time frame that we showed in the 6-month candlestick chart for gold. The range is just a bit wider here. 30.25 is where we're bouncing off of on a daily close basis. And we're hitting resistance at 32.75. So again, I expect silver to go sideways for the coming weeks leading into the end of this year and going into beginning of 2024. And with the current values for gold and silver in the spot market, with gold at $26.35 and the silver price at $31 an ounce today, that brings the gold to silver ratio to 85 to 1 exactly, which remains high. One of the people I had the good pleasure to speak at length with at the New Orleans Investment Conference was Avi Gilbert, who is a chartist like myself. And Avi reminded me that silver tends to go parabolic late in gold bull run cycles. So silver getting over $30 is a good sign, but he still thinks the biggest gains for silver will come when gold makes the next big leg higher. And I would tend to agree with him. It's what happened in 2010 and 2011, and it's what happened in 1978, 79, the last time we had two red-hot gold markets. Silver played catch-up with a vengeance late in the cycle. So I still think silver should be $40 to $45 an ounce based on the current gold price, but the potential for silver to go parabolic when gold makes another big move higher, which I think is inevitable, is pretty good. So time will tell. Finally, we are having our annual inventory reduction sale. It's in progress now. It's for what we have in stock. You have to call our account managers at 800-613-9323 to see what is available, but we are making deals. We'd much rather pass savings on to you for inventory taxes that we might have to pay at the end of the year, which is just a waste of money in our mind. We'd rather reward our loyal clients for the loyalty and trust that you've placed in us for the last 26 years. And this is another way that we can do that. And I would be remiss if I didn't say thank you so much for all the loyalty and support you've given us. If you like what we're doing, please subscribe to our YouTube channel and like this video. If you have any comments or questions, please put them in below. We'd be happy to address them. And I can't thank you enough. Hope you all had a wonderful Thanksgiving and that you all have a wonderful holiday season. We will have one more update before the year is out, which will be a year-end review. And thank you again for everything, your loyalty and support, and best wishes for a wonderful holiday season.